You know, when I started to trade in 2007, and every experienced trader I went to all said one thing: you must have a trading plan. And if you follow the trading plan over a long period of time, you'll make money. You won't make money in the short term. The problem was, though, no one really gave me a trading plan. My trading plan basically said, open the markets, find an opportunity, and trade. And then after 1 year or so, I found out that's not what a trading plan looks like. In this video, we're going to go through the process of building a trading system, right from thinking about the idea to actually making the rules, and then we'll see a few examples. But before we begin, we need to do one thing. Guys, what do we have to do?
Subscribe.
You heard them, right? Hit that subscribe button, hit that like button, and put something nice in the comments. Let's begin. The first step is to identify the market direction. Now, basically, you don't want to enter a stock which is going down or just sideways for a long time. So let's see some examples. I have Coal India over here, Coal India and State Bank of India, and we have Tata Motors. Here you'll see that the market is in a you get the point. It's a little confusing to know whether this is an uptrend or is it a downtrend or is it sideways or what the hell is happening. And you don't have to guess, right? So you have to have a quantitative, simple way of knowing whether it's an uptrend or not. And in step one, we want to find only stocks in an uptrend. So there are multiple ways to do this. You can use Dow theory, you can use that swing low, swing high thing I've been talking about for 10 years now, or you can use a moving average. But in this case, let's do something that's a little foolproof. We'll use an indicator called the Williams Alligator. The Williams Alligator is basically 3 moving averages, more or less. If those 3 moving averages are moving up, guess what? We are in an uptrend. If those 3 moving averages are going down, guess what? We are in a downtrend. So let's see what it looks like. The 3 moving averages that form the alligator is the 5, 8, and 13. And this is NTPC's daily chart. You'll see over here, you can see the green one on top, followed by the red, and then the blue. As they move up, you know we are in an uptrend. But the moment you see something like this, where it's not clear, you know, well, the trend is not clear, and you just remove that stock from your watch list. So very simply, you need the green, red, blue to be clearly moving up. That's when we know we are in an uptrend, and that is our step one. So we have the first thing, I'll call it Williams Alligator, and you have to make sure the 5 is greater than the 8 is greater than the 13. Basically, it'll look something like this. When we see that Williams Alligator is moving up, that's our first check mark. Now in step 2, we have another filter. Either you can choose a breakout or you can choose a pullback. Let me explain the difference. A breakout is when the stock is moving sideways, it has no idea what to do, and then at some point, it, breaks out. That breakout is a sign that momentum has happened and you might want to buy then. Another way to look at it, since we're looking at only uptrend stocks, is when the stock is moving up, you buy it when there is a pullback, because in an uptrend, you'll get these multiple pullbacks, right? You see this? Price coming down. So which one should you choose? Now, the problem with the first option, that's your breakout or breakdown, is that you need the stock to be in a consolidation for a long period of time. And that may not happen if the first condition is just an uptrend. So it makes sense to just do the pullback. So let's keep it simple. Let's try to find a way to identify whether it's in a pullback or not when the stock is in an uptrend. In step 2, we have to find out whether we are in pullback territory or not. And let's just turn it into step 3, okay? I'll explain how you find a pullback. For this, we're simply going to use an RSI, right? Now, why am I using an RSI? You could argue when the market comes down, तुम्हें तो पता चल जाएगा because तुम तो बहुत smart हो. Market गिर रहा है, uptrend है, खरीद लो. This is the problem, right? I think you've seen that meme. I keep buying the market dip, but the market keeps dipping. So you don't want that. We'll find a quantitative way of defining what a dip or what a pullback looks like, and we'll use an RSI to basically quantify that. Very simply, the RSI is an oscillator. It moves between 0 and 100. But generally, people look at 30 and then they look at 70. We'll look at 70. 70 is this mark over here. Basically, when the RSI goes above 70 and then comes back down, that's when you know a pullback is in place. The reason it needs to move above 70 is that RSI is measuring momentum that is moving upwards. So we are sure in an uptrend, when RSI is above 70, momentum is high. Profit booking is measured in a momentum downwards. So when we dip below 70, we know that a pullback has happened. Now, once the RSI has gone above 70 and then goes below 70, our setup is ready. So as soon as this happens, you know that you now are ready to take an entry, an exit, and have a target to this. But let me explain how that will happen. This means you need all these three conditions. Actually, there are only two conditions. You need this to be going up. You need RSI to go above 70. So it has to go above 70 and then come below 70 for your trade setup to actually exist. Now comes your entry point. We'll discuss that. Then we'll talk about your stop loss. And finally, we'll talk about your target. So let's see what these answers are. For entry, the bar that actually went above 70 and then went below 70, that is your trigger bar. Above the high of that bar is going to be your entry. Below the low of that same bar is going to be your stop loss. And your target is going to be 2 times the risk, that is entry minus stop loss multiplied by 2. So let me show you an example of the entry. So here you can see that the market is going up. So first question, do we have the Williams Alligator, all these 3 moving averages going up? We can clearly see the green, the red, and the blue is moving up. Can we see that the RSI went above 70 and then went below? So over here, we can see the RSI has always been above 70. And then over here, that dip happens and there's a long red bar. This is interesting. When the market actually fell, in this case, the RSI went from 70 to below 70. As soon as that happens, you should mark that bar. We'll call that bar our trigger bar. So as soon as you get that trigger bar, you could actually buy the stock here. This is the biggest mistake traders make. They assume they can find the entry point and the dip. The truth is, no one knows whether this is a dip or the market just crashes from here. So we need a confirmation. When we have a trigger bar, like this red bar over here, the only confirmation I can get is if the market moves above that bar. If the market moves above, it shows that there is strength and that was indeed a dip. So how would we do this? Basically, you can buy at the high of that bar. So that trigger bar, you have to wait. In this case, 1 day, 2nd day, 3rd day, 4th day, the market went above that trigger bar, proving that this was indeed a dip and the market went up, buying pressure came in. So the entry is going to be the high of the trigger bar. Now, the question to you is, where should we keep the stop loss? You can keep the stop loss at that green moving average. You could maybe keep it at a swing low. You could even keep it arbitrarily 2 or 3%. All of these ways are a little subjective and it could be wrong. Let's think it through. If the high of the trigger bar was the entry, what would be the stop loss? Well, very simply, the low of that trigger bar would be your stop loss. So the low of the trigger bar is the stop loss. So how do you decide a target? So a target should be relative to what stock you're trading, right? So what we can do is, whatever was the entry and the stop loss, let's take that as your risk, because that's how much you're risking. Let's suppose you wanted to enter at 100 according to the system and your stop loss is at 90. This means you're taking a risk of 10 points. If you have 10 shares, you would risk 100 rupees. If you had 100 shares, you would risk 1,000 rupees. You can measure the risk even before you've taken the trade. Isn't that interesting? That way you can adjust based on your capital, how much you want to risk in a certain trade, because the risk is now suddenly defined. What could the target be? Basically, once you found the risk, you just multiply that by 2 to give you your target. So I'll say 2 times high minus low of trigger bar. So now this means if you're trading a very volatile stock, your target will be very high. If you're trading a non-volatile stock, your target will be low. It's relative to the volatility of that stock. and that comes with your target. I hope this was not very confusing. If you can reach the first 3 steps, everything over here has to do with just the trigger bar, and then you just do this again and again to make sure that you're following this. One thing you'll find interesting here is you're only trading a stock in an uptrend. You're trading after a pause in a high momentum stock, a pullback. Second, your risk to reward ratio is 2x. So hopefully if more than 50% of your trades are winners, your overall system actually makes money. So a single trade doesn't really matter that much. Don't worry if you find this confusing, I will show you examples. The first example I'm going to take is HDFC Bank. What we've done is we've made sure we're only looking at Nifty 50 stocks and not a small cap. Please don't do that. So we have HDFC Bank here. Let's do our checklist very quickly. Let's start from this side. So first we need 1, 2, 3, these moving averages to be moving up. We can see that they're moving up. Check. Second, we need a pullback, jahan pe the RSI was above 70, then below 70. So here we can see the RSI is under 70, so it's not meeting our criteria. We go above that dotted line, which is 70, great. And then here we see that dip. Let's find the trigger bar. Okay, this small red bar is now a trigger bar. Ye trigger bar is now aapki duniya. All the next 3 steps revolve around this trigger bar. So the first thing we'll do is we'll wait for the high to be crossed. And you can see almost immediately the high was crossed and we have our entry. We know the stop loss because we'll place our stop loss at the low of this bar. And the target is basically entry minus stop loss times 2, which is roughly here. If the market hits that target, we're out. Or if the market hits our stop loss, we're out. In between, you're not allowed to look at television, not allowed to read the news, not allowed to predict. You just follow the plan and see what happens. The market went up and eventually it hit your target. And in this case, it was a profit. Now, whether or not this is a profit or not doesn't matter. The question is, were you able to follow the strategy or actually the setup that we discussed till the end? That's what matters the most. The next example is going to be Reliance. This time I'll move a little faster because I think you've got the flow. So first we can see over here that we are clearly in an uptrend with all 3 moving averages going up. We can see we're above 70 and we have a dip. See that red bar, that nice red bar? That's where we know above that we have to buy. This is a little scary. To be honest, Reliance jumped up and has been falling a lot intraday for the last 3 days. And you have to buy because, well, our setup talks about it. So you make that purchase. There is a stop loss. Let's see what happens. In this case, the market went up and you hit your target. It was a profit again. But you know what? Seeing profit trades makes us feel invincible. The truth is, most strategies out there are 48% profitable or 50% profitable, which means out of 100 trades, 48 will win and the rest will lose. Or 51 will win and the rest will lose. It's the risk to reward which actually makes you money in the end. So even trading is not a short-term endeavor. It requires a lot of skill, patience, and a lot of time. In most cases, well backtested systems can have a drawdown for up to 6 months. So you have to ask yourself, if you're in trading for quick money, please get out. This is not for you. Or you could just pick up investing long-term as well if you don't have patience, right? But let's see a loss example and see what that looks like. So here we have Tata Motors and you can see the Williams Alligator is obviously up. So all 3 bars, all 3 moving averages going up. RSI has always been above 70, but we see that small dip here and this small innocuous red bar is our trigger bar. Iska high is our entry. Agle din hi market gaps up and we have an entry point over there and we're sitting tight. Stop loss, as you know, is the low of this bar. That's the trigger bar. But the next day itself, the market opens flat, falls, takes us out, and we make a loss. Exactly how much we had planned, but it is a loss trade. What's worse? And this is worse than the loss. The market then goes up a lot. This is a psychological trauma that you'll face when you trade or invest over a long period of time. Everything could be right, but sometimes things go wrong, but that's completely normal. Now, make sure you write these rules down so you understand how sequentially to think and how to think like a systems trader and not a random guy who looks at the stock and says, "Badhiya lag raha, kharid lo." That's not how the market works. One more warning. This is a trade setup to explain what a strategy is. It's not an actual strategy. Please don't actually trade it. It is not backtested. Ideally, what you should do is take this information, backtest it on all Nifty 50 stocks for the last 20 years and see over the last 20 years what happened. Was it profitable or not? If you do want to learn a backtested strategy for free though, we run these weekend prime sessions. It basically primes you into the world of investing and trading for free. But only few people can actually get in because it takes a lot of discipline and trading, investing is not for everyone. If you identify as a person who really wants to learn this skill, fill up the application form you'll find in the description and Jai Mata Di bol dena, and make sure that you fill it up properly because only 30% of people get into Prime. There will be a live class for 2 days where you learn a back-tested system, not this one, and you can learn with a mentor. It is done with proof of work. You'll also learn in a community of other people like you who want to learn trading. And I promise you, it'll change your life. So here's a summary of this entire video. Check this out. These are the rules. And if you want to see more videos like this, because we have no idea whether you like this or not, we have to hit 5,000 likes on this video. If we do that, we'll make more videos like this. Also, you should throw in a comment or so because I think we all had a lot of fun making this. We enjoyed it. But whether we should do it again in the future, your 5,000 likes will tell us. So hit that like button, hit the subscribe, hit the comment. See you in the next video.
You should... I can start like this, right?
नहीं.
Fuck man, मैं इतना excited था मेरी ले ली उसने. रोल हो रहा है? Good job, Shaurya.
If you, what? Wait.
गांजा कहाँ है?
So sorry.
It's a nickname of a person.
Oh my God. It's a person.